So thanks for joining us, Carina, and welcome. And so we're happy to have Carina here with us today to talk about the acquisition of Beyonic by MFS Africa.
Thank you. It's so nice to be here. Nice to talk to you.
Good. Carina Rumberger is the CEO of Beyonic. She drives strategic growth, new market entry, capacity building, team and project management, systems design, and implementation. She's been working for over 10 years across Eastern and Southern Africa in SME development, compliance, stakeholder engagement, capacity building, and last mile delivery across a range of different financial organizations. And she's going to share a lot of that experience with us, and specifically the journey at Beyonic from when she joined it through the exit. So I'm going to start with a bit of background about you and just sort of ask about your journey through Africa FinTech, how you started, what got you into this specific field, and then we'll get into how you got into Beyonic specifically.
Sure. So I have kind of a circuitous and not particularly intentional path to where I am now. Okay. I had done some studying and then worked as a teacher in Tanzania back in the early aughts, and then found myself working in sub-Saharan Africa, based in South Africa as a management consultant, primarily looking at ESG compliance on large infrastructure and energy projects. I did that for a while, and then I founded a firm doing something very similar in Tanzania. So again, risk, compliance, capacity building, last mile, everything in Tanzania, but working on projects across the continent. And through informal networks, ended up in touch with Luke Johari and Dan Kleinbaum, who are the founders of Beyonic. They had started this exciting payments company and were looking for some strategic advice to look at how they could scale and grow their business. They'd just hit profitability in early 2018. And when they reached out to me, it was more on a consulting basis to look at how they could scale and grow and sort of standardize what was a real scrappy, do whatever you need to do to keep the doors open and the lights on week to week startup into something
I
that
have
could
no experience with that.
Yeah, right. It's adrenaline. Every day is a new day. So that's how they reached out to me initially. And very quickly, I was excited about fintech because a lot of the same principles apply as do in any business. You need to have, sound business model. You need to be able to demonstrate a return on investment. And fintech's exciting to me because it has impact across a wide sort of number of indicators. It's about financial inclusion. It's about cleaner, more equitable access to products and services. And it's about reducing inequalities that are amplified by large geographies and poor infrastructure and, governance that is variable in terms of its support of small businesses and individuals. So fintech was exciting. I saw a lot of parallels to work that I had been doing in other sectors and was excited about bringing some of that knowledge and some of that experience into fintech. It very quickly became clear from that engagement that it wasn't just a consulting gig, that it was an audition for a C-suite role. And so I joined Beyonic full-time as strategic advisor for growth in August of 2018. And by the beginning of 2019, the board asked me to take over the mantle of CEO from Luke, who was the founder and had been wearing all of the hats: CTO, CPO, COO, CEO. And at that point, we recognized that while we'd hit profitability in 2018 as I was joining the company, we also experienced exponential growth. And we very quickly, we had a capacity issue. So in order to serve the growth that we wanted to keep up with, we needed to scale pretty rapidly. Some of our teams, some of our systems, our infrastructure, et cetera, stuff that you keep real tight and lean when you're in that early startup phase. But then the minute you want to be able to sustain your own growth and not be crushed by the exciting success you're experiencing, you have to be able to kind of quickly reinvest in those so that you've got a firm foundation. In our case, that meant a capital raise, and that kind of brought us to mid-2019.
Okay. Talk to me about taking over as CEO from a founder. was about this when we're prepping for this call. I'm also a CEO who's taking over from a founder in a business. But what was that experience like for you? What was that transition like between you and Luke? Talk a little bit about that.
Yeah, it's a really interesting question. In my experience, and that's really the only thing I can speak to, and I have to give Luke a tremendous amount of credit here. He's not a founder with a huge ego, which I think it can be pretty special, especially in a space where you have to be pretty confident in order to build something that works in a complex, very mobile environment, right? So I was fortunate in that regard, for one thing. Luke and I would be lying if I said there were no bumps in the road, but it really is like any relationship, a friendship, a partnership, anything. You have to trust, and you have to learn, and you have to be vulnerable. You have to communicate and communicate and communicate. You have to work on it when it's not working well. And we just had to go through that process. We had to do the work and become partners. It was interesting for me because as I was coming in, Luke's co-founder, Dan Kleinbaum, who's still on our board, was moving out of an operational management role. He'd been filling the shoes of the COO. Yeah. And so I was stepping in to a relationship that was also kind of like Luke was dealing with Dan's exits from the management team while he was dealing with my entry. And I was dealing with both. And Dan, to his tremendous credit, stayed involved and was very available and incredibly supportive. And I think that was an incredibly important part of Luke and my partnership becoming successful. Our working dynamic was aided by Dan's cheerleading and support and advice and sort of perspective, having been on both sides of that equation. So, taking over it, the biggest challenge I think was around, when you've got a founder, so much is typically in their head, yes, which means that they just do everything automatically because they have that vast store of historical knowledge. And it's difficult for them often to download that data into somebody else's brain, and it's really difficult to do it in a systematic way. In our case, it had nothing to do with appetite or willingness to share information or to relinquish control or delegate responsibility. It had everything to do with just being busy and not always remembering what it is that you know and why it's important and how it fits in. So there were a lot of things, like a lot of conversations that would go something like, oh, well, we've got this thing coming up, we should do X about it. Or I have this engagement with a customer and be like, oh, I forgot. There's a lot of history. I was like, oh, tell me more. Yeah. So those kinds of conversations. And you just have to do the work. You have to push through it. And it's aided by trust and the assumption of good intent on everyone's part. So I was really lucky there.
Interesting. I won't belabor this, but I'm going to ask one more question about that, which is, what are the specific sort of skills that the board thought you were bringing in, or the specific role that you were playing that was different from what Luke had done? And into what space did they then transition, or did the company and Luke himself, I'm sure, of course, then transition? Sort of what were the skills or the expectations for you as CEO that were different from what he'd been doing?
Absolutely. So I am a non-technical person. I have zero engineering background whatsoever. I couldn't code if my life depended on it without a lot of support and education prior to that. Luke is an engineer by training and tremendous amount of global experience in that area. So we come to solving problems from very different perspectives, and we have different strategies to solving any kind of challenge. So one of the things that the board saw in me was just a different approach and a different perspective. And the more diverse of a perspective that we bring to any challenge, the more nuanced, rich, and potentially innovative and practical are potential solutions, right? So there was that piece, there was the diversity piece. I've been located on this continent for the better part of 15 years. Luke splits his time between, he's from Uganda, but he splits his time between East Africa and the US, in part because of access to kind of global headquarters for investors and for customers, but also because his wife is American, and so he has family in both places, as do I now as well. So in that respect, we're a bit the converse of one another. And it's important to have that physical presence in both places in our case. So that was another thing that I was bringing to the team. And then a lot of it was around my background and experience in strategy and translating strategy into systems. So doing things in a coordinated and prescribed way without losing the efficiency and the efficacy of just kind of reacting on the go. So simple things like management structures, reporting lines, reporting templates, those sorts of things that are necessary in order to scale an organization. Luke and Dan saw very, I think it takes humility and self-awareness to see where our own gaps are. And they saw that that was the gap in the leadership team, was that ability to sort of standardize, systematize, and grow.
Yeah, so it's not sexy stuff, but it's essential.
So no, absolutely. I mean, I sometimes joke because, payments is pretty niche. My family has no idea what I do really, not because they don't care, but because what? And I often will say two things. One is that I basically work for PayPal in Africa. It's a little different, but that's the basic premise when I'm talking to European Americans. And my role in the company is I'm kind of mom. I need to make sure that the books are balanced and things get done and everyone's fed and clothed and cared for. Yeah.
Okay, so let's talk about that. I mean, your PayPal in Africa analogy is an interesting one. I want to talk specifically about what Beyonic does. And then what MFS does, because I don't think that's actually a great analogy in terms of
totally very blunt. It's very blunt, and for this audience, that's not an appropriate analogy. But when you're talking to, folks who have no concept of what mobile money is, it's kind of the baseline.
Yeah. So tell me exactly what Beyonic does.
Totally. So Beyonic recognized that as mobile money penetration just skyrocketed across East Africa initially, that there were a number of small businesses and enterprises that needed to be able to access consumers via mobile money, but that there weren't appropriate business tools in place to help them do that in the way that they're able to do that using online banking or QuickBooks, for example. But in order to reach the base of the pyramid and the vast majority of East African consumers, mobile money is this incredibly powerful agent. And so Luke saw pretty early on, 2008, 2009, look, there's an opportunity here to serve a segment that's not being served. And that's small, medium enterprises operating in Eastern Africa who need robust business continuity tools to run their organizations, but that are linked to mobile money. So there's the first pain point of linking to multiple telcos, and that's the initial aggregator model. One connection to Beyonic enables an enterprise customer to pay and to collect payments from consumers on more than 26 different mobile money networks, and that's growing every day. So that's a huge efficiency right there for a small organization, 10, 20, 50 people, to do an integration to every single MNO in East Africa alone would take years, and it's complicated and it can be very time consuming. So that's the initial use case. And then what we found is on top of that, there are a lot of business functionalities, a toolbox, if you will, that sits on top of the rails. So things that help enterprises control their cash flow, or what would have been cash flow that's now digital mobile money payments, authorization and approval cycles, identity verification, name checks. We have an analytics dashboard that enables organizations to analyze all of their financial and operational data that they're running through our platform. We added bank connectivity last year. So in essence, it's a suite of payments management tools and functionalities that sit on top of the rails that give small and medium enterprises operating in this part of the world access to base of the pyramid consumers.
Okay, so that's fantastic. And then on the other hand, MFS was doing a different thing, which is transfers from mobile money wallets country to country.
Exactly. So MFS Africa's founder, Dare, set out to, he basically said, I'm living in Nigeria or South Africa. My mom is in Benin. I can phone her. Why can't I just send her money? That seems like a problem. We should solve that problem. We should make the borders matter less. And so they set out to build a hub that would enable mobile money network operators and individuals subscribed to those mobile money networks to send value to any other user on any other network. And that's what they built. So what they did was about cross-border exchange of mobile money from one location to another, different corridors, different nodes, et cetera. What we did was domestic payments and collections for small, medium, and mid-sized enterprises. So where they stopped, we started, and vice versa. And we would often have that conversation with customers. They would say, okay, so you're using us in Uganda or we're using you in Uganda, Kenya, and Tanzania. Can we just pay a supplier in Tanzania from our HQ in Nairobi? And we're like, well, that's not really what we're set up to do. We just do domestic collections and disbursements in local currency and help you manage those flows. We can do that for you in Tanzania and Uganda and Kenya, but you have to pre-fund each of those wallets in local currency.
Gotcha.
We don't do Forex, we don't do cross-border. MFS Africa was having the opposite conversation with their customers where they'd say, oh, we can get the money into the country. Great. Once we're there, can we, then distribute it, or can we then collect? And they were having to say, yeah, no, we don't have contracts for local currency, transactions. That's not what we do. So it's a really nice, sympathetic, complementary relationship, if you will. Very little overlap, lots and lots of complementarianism.
There's an interesting word you just mentioned. You mentioned contracts. What's interesting about that is that basically you're saying beyond the technical capability to do in-country transfer for MFS, they didn't have the actual licenses or approvals that's required to actually do that kind of transfer.
Right. So they're different, they're different contracts with every mobile money network and then different permissions. So domestic disbursements and collections and transacting is regulated totally differently and priced totally differently to cross-border and FX. Yeah. And so we focused on the former, they focused on the latter.
There's an ongoing joke. There's an ongoing joke in sort of fintech Twitter about sort of the fact that everybody thinks they're going to come into fintech to do really cool, sexy technology, and they end up doing contracts. It's just paperwork and compliance and regulations.
100%. One of the things, people ask a lot what some of our greatest challenges are, and it's fragmentation in the marketplace. I mean, we serve customers across sectors in multiple countries. They all have different compliance requirements. Every sector is regulated differently. And because of fragmentation in the market, investors, serious investors, require certain potential market size. And outside of Nigeria and South Africa, you've got to start looking at blocks. But those blocks are heavily fragmented. And that's one of the pain points that we try to lessen for our customers. How can we make that fragmentation less of a barrier for our enterprise customers to grow and attract investment?
Gotcha. Okay, let's talk a little bit about this deal specifically and how it started to come together. You guys know each other, you're doing different things, you're talking to your clients, and your clients are saying, we want this and you can't deliver it, and they want that and they can't deliver it. What was the first sort of real interaction between Beyonic and MFS?
So the story started before I came on board. And Dan had participated in the Techstars Accelerator program in Cape Town in 2016. They raised 500,000 in seed round. And they decided on the back of that they wanted to hit profitability, which they did. But during that process, Luke and Dare had bumped into each other, and then they kept sort of track of each other. And we would hear MFS Africa's name, they would hear ours. But we were kind of playing in adjacent spaces. In 2018, MFS Africa started to see a gap. They're focusing on, kind of P2P consumer cross-border transfer, right? And they were seeing kind of frequent users who were transacting regularly. So it's an individual and they're sending money on a pretty frequent basis in pretty high value amounts. And what they're recognizing is that this is starting to look like business traffic. not consumer traffic. And so there's a super consumer that's sort of maxed out functionality of consumer facing products and isn't yet being served by banks and larger financial institutions, more conventional ones. So they saw that gap in the market and they said, that needs to be filled. How do we fill that? And they recognized that that's really exciting, but outside of their wheelhouse. So that was what was happening for them in 2018. If we go back to what was happening for us, we'd hit profitability, we started to experience exponential growth, and we realized that we needed to scale out our systems and our teams and some capacity building pretty rapidly. And what that really means is a capital raise. So Luke and I sat down and said, all right, let's decide how and when we want to do this. And we agreed to start opening. We opened up the round in Q3 of 2019. And just sort of as luck would have it, Dare was looking to solve this problem and thought, hey, wait a minute. That sounds an awful lot like what Beyonic does. I wonder what they're up to these days. So we pinged Luke in November or October of 2019. He said, hey, what are you guys up to? And Luke said, oh, well, we're good. We just opened a Series A round. And that's going really well. We're getting a lot of enthusiasm and excitement, et cetera. And Dare said, okay, that's really interesting. Let's talk. So the two of them sat down, had a meeting. And the first I heard about it was Luke gave me a call and said, hey, so you're not going to believe the meeting I just had with MFS Africa's CEO and deputy CEO, Rachel. And I said, well, that's interesting. We weren't really looking for a strategic investor who would take an operational stake. But I mean, we can have that conversation. You're raising money, like you're going to talk to everyone, right? So I didn't think a lot of it, but it very quickly became apparent that they were serious, and they were serious about not just injecting capital into the business, but actually taking an operational stake. And as we had some of those conversations and they became a little bit more detailed, pretty quickly realized that anything other than a pretty deep integration of the two organizations would create problems down the road in terms of alignment, synergies, cultural growth, exchange of information, and leveraging our respective capabilities to their fullest. So suddenly it went from, well, we'd like to be an operational strategic partner to, well, we'd like to lead the round. And then it very quickly, Dare's phrase is, we didn't want to end up half pregnant, which is quite descriptive. So of about 2 weeks. And I very quickly hopped on a plane. I went down to Johannesburg and I met Dare for breakfast. And in my mind, I said, okay, buddy, you have 1 hour to convince me that I should trust my people with you. And he did. What I was looking for were shared values, shared vision, an organization who understood that our greatest resource is our people, and we have to treat them as such, and that we are able to balance the importance of a return on investment with socially responsible entrepreneurship, solving problems that matter. And those things aligned real quickly. And for both of us, that was kind of the first piece that had to fall into place. So we had the product synergy, we had the cultural compatibility, sort of shared vision and values. And then it was a question of, well, can we make this work for all of the boards and all of the investors? And we got to terms pretty quickly. By December, we were talking terms sheet, and by Christmas, we'd signed.
Fascinating. Talk to me. So I'm going to get into some of the stuff that gets sticky, like getting to a number or getting to numbers that make sense, because leading a round versus acquiring a company are two very different conversations. So, what's the shift in that? How do you price a company that's getting acquired separately, different, from a company that's saying, you're leading a round. I think you guys had raised less than $1 million between seed stars and any other sort of investors prior to that point. So you're going out, and I don't know, how much were you looking to raise, in a Series A versus them having a conversation about, we're going to get acquired, and so this is what we got to give as returns back to our investors or whatever.
Yeah. Absolutely. So when we were talking about just raising capital, we were not planning on giving away more than 20-25% of the company. So valuations, as you know, they range wildly, and we're not disclosing numbers, but it was really important that everybody come out of this feeling good about it at the management and operational level, because we need to be able to work together. And we needed our investors to honor their involvement thus far. And how those conversations happened, how numbers are achieved, et cetera, and then shared and agreed, I have to give tremendous credit to Luke and Dare.
Okay.
That negotiation happened between those two people under the assumption of good intent and never forgetting that the end goal was to do great things together that we both care about. And that was critical. I think without those two underlying commitments between the two of them, and without their commitment to respectful and congenial negotiation, and then taking the results of those conversations between the two of them back to their respective internal stakeholders, so investors, board members, management teams, it wouldn't have gotten done. And
I mean, let me ask something about that. I'm just going to interrupt you a bit. That's assuming that basically they're having a conversation and they both know that as long as I come back with a decent deal, I can sell it to these stakeholders, basically. Because for you to have a one-on-one conversation and agree on a number or agree on even a range, it does mean a certain comfort with the fact that I'm not going to take it back and it's going to get thrown out.
Absolutely. Absolutely. And keep in mind, like, that is many conversations. I don't know that they've ever tallied the hours that they spent speaking to one another, but those hours are what formed the heart and soul of this deal.
Interesting. Let me ask you a question. Going into the conversation, and I imagine you could speak a bit more for the Beyonic side, what mandate did Luke go into? And I mean, he's CEO, so he's making deals every day and he's looking for opportunities every day. But the first time he comes to the stakeholders, and that's team or board or investors, and says, hey, I've had this conversation. And you've talked about your initial reaction, which is we were just looking for, a financier. We're not looking for an operational or strategic investor. But then when he comes back to you and he says, well, this is looking like maybe they should just buy us out, what does he have to, and I think I'm a little bit less concerned about you, particularly being internal stakeholders. I'm thinking more about investors. I'm thinking more at the board level. What's that conversation like? Like I'm thinking about getting bought out. Are they enthusiastic about it? Is it actually, we were planning to write this out to, unicorn status or, I perish the word.
Yeah, absolutely. So from the Beyonic side, we were really fortunate to have a committed, involved board. They were very supportive. What they wanted to see is that they needed a return on their investment, and they needed to see that we were making good business decisions. So however we were capitalizing our needs operationally for scale, that needed to be reasonable and sustainable. We needed to make sure that we were not getting ourselves into a situation where we're going to kind of cannibalize our own success, and they needed to get a return on their investment. And within those kind of broad parameters, they were very supportive and flexible. So I've, a lot of appreciation and respect for that and for that process. And they gave great advice throughout the entire process, which was fantastic. And as I said, we're not disclosing numbers, but the investors who are cashing out at this stage are walking away with 5x return on their investment. So they're happy.
That's not bad. 5x over how long were they in?
They came in, there were a few early pre-seed stage investors, but the bulk of those investors came in 2016 during the seed stage. So, yeah.
Okay. So 2016 to 2020, 4 years, not bad. Not bad for 5x exit.
50%, about 50% of our shareholders are cashing in, and 50% are rolling over into MFS Africa shares.
Okay. Yeah. So talk to us of the deal making, and this really is for the audience in terms of how you make a deal like this. What are the potential stumbling blocks? Did you guys have any late challenges in terms of actually putting the deal together? I understand it's not completely closed yet. You guys are still finishing compliance and regulations, but talk to me about the deal making and the process and where the potential stumbling blocks are.
So yeah, just to be completely clear, the final closure of the deal is waiting on FCC approval. So the Fair Competition Authority in Tanzania still has to sign off on it.
Yeah.
But I think the biggest potential stumbling blocks, I'd kind of divide them into two categories. One is more on the due diligence and compliance side of things, and that really is around the fragmentation I mentioned earlier. You know, we're an organization with entities and subsidiaries in five different countries. And so there's a different due diligence process and level of comfort and familiarity for each of those opcos.
Okay.
And there was zero overlap between where we're incorporated and where MFS Africa is. So that's fantastic for future synergy, but it meant that there was a big learning curve on everyone's side for due diligence. So that would be the first bucket of sort of challenges, was around making sure that we were comparing apples to apples and that the information that was available and needed to be disclosed was comparable from OpCo to OpCo, and that all stakeholders were on board with, you know, various risk profiles for different operations and markets, right?
Gotcha.
The second sort of bucket of stumbling potentially was around, as I said, the product was super complementary and the footprint was complementary. So those were pretty easy. Like, that was not a hard sell for anyone. The synergies were obvious. The second one is around, how do you take two teams and effectively bring them together without anybody feeling sidelined or passed over? How do you make sure that you take two company cultures that are distinct and blend them together so that they become something unique, and one doesn't just feel like they get subsumed by the other? Because it was really clear from the beginning that MFS Africa was not buying us for our, you know, client list or our tech stack alone. They were buying our very high performance team capacity because they needed to grow into that space rapidly. And one of the ways you can do that is through an acquisition like this. Gotcha. So it was both conveying effectively that vision and assuring internal team members that, hey, like, this is not about getting bought up, chopped up, and sold down the river for parts. This is a merger in the true sense of the word, where my job in particular was to help convey to my people, my team members, the vision and the goal for an end state of two organizations becoming one that was contagious in its ability to ignite enthusiasm and energize teams, as opposed to just leave people feeling overwhelmed and out in the cold. One of the questions I get a lot is, well, how many people are going to lose their jobs as a result of this deal? And none. In fact, we're hiring. Both teams are hiring. Okay. And we're really proud of that. That's important.
That's a great outcome. That's a really good outcome if you can get it. Let me ask about sort of that people thing. I was looking at the MFS Africa sort of like website, Our People, and Dare is from Benin, and the deputy CEO is American, and the CPO, the chief product officer, is from Sweden, the CTO is from Malawi. You guys have the same thing, Luke from Uganda. Talk to me about sort of meshing those cultures, meshing like that deal making. Mm-hmm. And sort of integrating those teams together.
Yeah, absolutely. I'm so glad you asked, because it's one of my favorite aspects of the people part of this deal. And that is that both of us have vision and value-driven founders of organizations that have diversity baked into their bones. And that's really important, because there's no assumption of any sort of linguistic or cultural homogeneousness, sorry. So there's never been an assumption that, oh, like, I'm American, you're American, we can just get this deal done. It's always been, we have to sell each other on the vision, on the values, on the process, on the product. And for example, when, like you said, when I go to my executive team, our combined executive team as a group, I sell an idea to people with vastly differing life experiences and perspectives. And in my opinion, that is how the very best ideas come to fruition, because it means they stand the test of being examined and weighed and considered from multiple perspectives, and it's still found to be valuable enough to implement. And because of that, I think we are walking proof of why organizations who are fundamentally diverse punch above their weight. And that's super important to both of us as
what are the downsides of that? What are the downsides of that diversity? I mean, let's be practical here.
So I mean, practically speaking, we are an English language speaking group, but we do have a pretty substantial portion of our organization that operate in French much of the time. So there's a lot of linguistic diversity, but more importantly, intercultural communication, whether that's the difference between being somebody with a background in like qualitative research like myself and an engineer communicating about process and approach and strategy, or the difference between two people coming from different languages or different kind of cultural backgrounds or different genders. What it means is that we have to focus on being effective with our communication. We have to over communicate without being inefficient, otherwise you just lose too much time. And we have to have those underlying assumptions that characterize Luc and Dare's engagement from the beginning of, we assume good intent, we assume the value of that working relationship, and we assume the significance or the shared vision and values, right? So around that, communication is a habit, right? If you get into good habits, you can get into bad habits. And we as an organization have to practice good communication in order to get things done. But the result of that, while it can be a little messy in the process, is an exciting place to work and solutions that innovate from places and in ways that they wouldn't if they hadn't been considered from so many angles.
Gotcha. Interesting. Let's talk reach.
Can I give you a couple of numbers on that? Because I get really excited about this.
Bring it on.
To just give you an idea of what I mean when I say we have diversity baked into our bones, the combined org has just surpassed 100 employees globally. We speak 50 languages, and we hold passports from over 24 different countries. So there is no majority in this organization. There are only people.
Wow, that's incredible. Passports from 24 countries, 50 languages, and over 100 people.
Yep.
Fantastic. Wow.
Yeah.
Okay. That's a diverse organization. Interesting. That's no monoculture. I want to talk about reach. So you've got all these passports, you've got all these countries. You're East and South Africa focused currently?
Not really. So MFS Africa really started off in West Africa.
Okay.
Serving the West African market. South Africa became a good place to base operations because it's such a well, not now, but in normal times, it's such a good point of connection. It's such a transport hub in terms of accessing, all different parts of Africa. So South Africa came later for MFS Africa. They started off working in mobile money in predominantly West Africa, and connecting those markets, and then grew east and south. Beyonic started off in Uganda, moved into Kenya, then Tanzania, then Rwanda, then moved with some customers into Ghana, Somalia, Zambia, and Malawi. So definitely much more like east heading west, and then they're west heading east and south. So we converge nicely in that regard, and also north. I mean, we cover more than 30 countries in Africa now.
So it's really interesting. I'm going to get into a little bit of the AFCFTA, this idea of, look, we're all going to be trading with one another. I think MFS starts from an interesting perspective in terms of making mobile wallets interoperable. So I've got an MTN mobile wallet in this country. I can transfer it to one in a different country. Let's talk vision in terms of how you guys tackle the entire continent and sort of what success looks like for this combined company in terms of what it can do across Africa and what it offers customers across Africa.
Absolutely.
Is there a vision that you can speak to on that?
Yeah. So the overarching vision is to make borders matter less. MFS Africa started making borders matter less for people. Beyonic started making digital transacting across different mobile networks easier for organizations.
Okay.
Combined, what it means is we want to make borders matter less for people and companies in order to accelerate access to a vibrant economy.
Gotcha. So let me ask about competitive set. You know, I understand what your mission is. Who do you consider competition in this mission across the continent?
Absolutely. No, absolutely. So there are the Flutter Waves, the Paystacks, the Cellulants of this world, the Segovias. There are various people, and the space is crowded. Payments is crowded, and it's consolidating rapidly. We've seen some big acquisitions just this quarter and this year, despite a global pandemic. So it's an exciting space. It's one that isn't fully mature, and because of that, there's a lot of movement. It's very dynamic right now. So we see this space becoming a game of few, and we'll be one of them.
Interesting. So there are more deals like this coming very, very soon.
Absolutely. This is consolidation is the stage the market is at.
Gotcha. Okay, we're at about 45 minutes, and I've seen a couple of really interesting questions in the Q&A already. So I'm going to jump into some of them. I still have a few more, but let's jump into some of these that are interesting. So David Adamu is asking about, in making the sort of decision to do this deal with MFS Africa, what are the trade-offs in terms of just raising another round and finishing your raise and continuing on your journey as you were going versus being acquired? You know, are there downsides to this? That's a pretty important question, I think, actually.
Absolutely. So the downside is that you lose some control. You know,
okay.
If we're just raising a round, Luke and I, we onboard, say, a CFO. That was our next sort of C-suite hire.
Gotcha.
Is planned. And the three of us, we run stuff by the board, but we have a lot of ability to make quick decisions, right? It's pretty simple. It's pretty straightforward. Decision-making mechanisms are easy. So that's what you give up. What
Gotcha.
you gain, however, and in our case, I believe that the trade-off is 100% worth it. You gain that diversity of experience and perspective, which makes you stronger. I wouldn't trade that for the world. Yeah.
Interesting. Interesting. Okay. And mission-wise, does this feel like, ultimately it's a bigger mission than what you were doing sort of solo, but does it feel like maybe there was more work to do on that mission and you could have deepened or moved faster if you just stayed focused on sort of your original mission versus taking on this sort of broader role that MFS Africa sort of like takes you into? Or no?
I don't think so. No.
Okay. Yeah, that's the extent of that answer. Okay.
In my opinion, we're not giving up any depth to acquire breadth. We're doing both. So we're all just super, super busy.
Gotcha. Okay.
Yeah.
Okay, I've got a question from Anu here, which is an interesting one. He says, if you can't disclose numbers, can you give us a ballpark? I think as African startups are being sold, we could do with a signal of what companies are worth, the growth currently being experienced.
Oh, that's a tough one. I can't disclose numbers, but what I can say is I think that on this continent, we've been running other people's playbooks, as Dare would put it, for a long time. We've been playing by the rules set in other markets by investors investing in other kinds of businesses. And the fintech in other parts of the world grows differently. It capitalizes differently, it scales differently, and it generates revenue differently. And I think that we have to be willing to tell our own story and write some of our own rules. And that includes valuations. It includes how we get to a number that works and how we value a company's potential.
Okay.
To be honest with you, I think that there are a lot of really important lessons to be learned in the broader global, venture capital and equity communities around coming out of the consolidation that's happening in African fintech right now around things like profitability and sustainability, and looking at like ad-based revenues as a business model doesn't work on this continent. So what does? And I think it's important for us to not feel tied to other people's rules, including in how we're evaluated. I think massive, crazy valuations aren't sustainable and they don't do anything good for the sector. But I think undervaluing our worth is never a good sign.
Okay. Interesting.
I'm not trying to be cagey there. I'm really just saying the rules are a little unwritten, honestly. Yeah. And so let's like take advantage of the opportunity to write those rules in a way that makes sense.
So I'm hearing a call for realistic valuations. Yeah, I'm not going to say too much more about Silicon Valley and Silicon Valley valuations, but I'm hearing a conversation around realistic valuations that do take into account the fair value of a company or the fair value of profitability.
A company's ability to like stick it out, right? Like you can have $1 billion idea, but if you can't operate in a particular context, it's useless.
Fair. Okay. Let me ask, I'll do another probing question, which is, you guys got to profitability in 2018. Beyonic got to profitability in 2018. At the time of the acquisition, were you still profitable? Because you had talked about sort of like a pretty accelerated growth. So still profitable at the time of the acceleration.
Just hovering right there at break even. So it's like kind of a weird place to be, right? And this is where I say the rules, the playbook doesn't always work. Because sometimes we would speak to investors and they would say, oh, you're profitable. Well, that's weird. And we'd be like, no, it's good. It's a good thing. And then we're like, well, then why are you raising money? Well, because we're a little hamstrung to grow. And so it meant that we were a bit of an ununderstood quantity for a lot of conventional VC funders. And there was a little bit like, you're damned if you do, you're damned if you don't. Like we want a company that's profitable, but then we think you should be talking about debt equity. We want a company that hasn't hit profitability yet because that's the conventional fintech VC target. Yeah,
I get you. I mean, let me ask related questions about MFS, because I know MFS raised in 2018 or early 2019. And are they profitable prior coming into this, or growing off of sort of like investor capital?
I can't really speak to that.
Okay. All right, fair enough. They're interesting questions. I mean, they're interesting questions. And I did a bit of homework before I came into this call. So I know just even the idea that a company that had just raised sort of, that was just raising, was already starting to do investments into SMEs or into other businesses was a bit of a conversation for MFS to have with its own investor board. And so what's interesting for me is in looking at the ecosystem, in looking at, like you said, the Flutterways, the Paystacks, the Cellulants, and what's possible for companies at whatever stage all of them are. You know, it's like, do you have to get to profitability before you can start doing these roll-ups and these acquisitions? Do you have to, you know, can you do it while you're still raising, while you're still on your own growth path as a company, basically?
And that just takes me right back to my previous answer, which is you got to figure out what works. You have to figure out what makes the most sense, and you need to have investors that back you and believe in that, both in your vision, even when it's not entirely conventional or familiar, and in your execution, in your ability to execute on that vision. And I think this deal is a great example of investors doing just that, saying, well, this is a little different, but we believe in the vision, we believe in where it's going, and we believe in the key personnel's ability to execute on that. And so far, we've proved them right.
Fantastic. I have a kind of related question to all of this. David Adamu again, asking about, would you advise startups on whether to publicly disclose details of a deal or not? And so there's a few things you're not disclosing or not able to disclose here.
Yeah.
Why? What's the thinking? What's the, you know, what are the elements?
Yeah, you know, so each deal is unique, just like each child is special, right? You don't have, as a parent, you don't pick your favorite kid. You just know that each one has got its own unique strengths and weaknesses, and every deal has got that same unique quality to it. And particularly in this space where the innovations are so many, and the operational sort of variability and fragmentation between markets is so great, you're not going to see any two deals done that look the same on just about any level, even if they're all about consolidation, or they're all about Africa, or they're all about fintech. They're each going to be unique. They're each going to have their own story. And so it's important to see the movement and the appetite and the confidence that the market has globally in what's happening on this continent and in this space. But it's also important that any one deal be inappropriately or influenced in an outsized way by the others. You know what I mean? They need to be taken and evaluated for their own merits in each case.
Yeah, gotcha. Okay, I think that's interesting. There's a really interesting question here. How does the MFS Beyonic group think about innovation in the mobile money space with respect to the possibility of growth plateauing? Like, will users ever become too sophisticated for mobile money?
I think mobile money is just one version of digital value.
Okay.
So whether it's mobile money, so mobile money is exciting here because it just suddenly dropped all of these physical and time and cost barriers to transacting and participating in economic activity, right? Digital was in many ways a big equalizer because of mobile money. That's specific to this continent. That's not true everywhere in the world. It's not even true equally across the continent. You know, the marketplace in Nigeria and South Africa is totally different than the one in East Africa, for example, just in respect to mobile money. So to go back to the question, yeah, people could very easily outgrow mobile money, but mobile money will just become one kind of version of digital value. And what we're talking about is being able to transact digital value, moving value from one place to another digitally.
Yeah. I think what's interesting, about that question and the reality of the markets is, if you look at somewhere like Asia, mobile, and not necessarily mobile money, and I have to say that I find like the fintech obsession with, is it mobile banking or is it mobile money? I find that very, I find it doesn't matter to consumers. Like, consumers want to, like you said, move value from one place to another, and they don't care whether it's moving by mobile money, as long as it's simple and easy to use and works instantaneously and safely every single time. But I do think that the example I see from Asia is mobile will stay king, and even a really sophisticated customer is happy to use mobile because, and even across Africa, in Nigeria, you see that. It's like people want to move larger and larger sums of money via mobile money or mobile banking because this is easy. This is quick, this is easy, this is convenience because it's always with me. So even if from a business perspective, if I can approve payroll from my phone, let me approve payroll from my phone.
Absolutely, 100%. We've all got little supercomputers in our pockets, and we live in a really fast-paced, complicated world. Anything we can do to make it a little bit simpler, a little bit easier, a little bit more intuitive, of course we're going to do that. And mobile money networks did an amazing thing in that they leveraged our human need to connect and communicate to KYC millions and millions of people. That's the magic there. Yeah. And until somebody else figures out a better way to do that, it'll stay king for a long time.
Fair enough. Just for anybody in the audience that doesn't know KYC, because fintech people always KYC, it's know your customer. And so it's one of the requirements for actually being able to move money beyond a certain value in most markets. Your banks or regulators will insist that you know a certain amount about your customer.
I just did that thing. Just threw it out an acronym.
The jargon. It's so everybody knows the jargon. Okay, I've got a question from Cesar Tagbajumi, who has a solution, a mobile proximity API to help solve mobile money fraud in Africa. And it's advisable to partner with MFS Africa and Beyonic as an added value solution. So I doubt you can approve this partnership on this call, but I guess, yeah. Are you guys open to partnerships with mobile money fraud solutions and the like?
Yeah, absolutely. We're looking to solve some problems. And I think this deal has just reinforced the fact that we're pretty flexible about how we do it, as long as we do it effectively and it serves the vision. That's a huge problem. And anything we can do to make transacting in mobile money and in the digital ecosystem safer for consumers and for businesses, it's a win.
Yeah. Okay. Clinton Da Costa Brown wants to know about the growth strategy looking forward. Sort of how are you guys going to achieve more sales? Are you looking to grow more propositions and use cases, or are you going to sort of continue to focus on your initial core?
Absolutely. When you think about it from a user experience perspective, we were just talking about like, how can we make this fast-paced, complicated world simpler and easier? That's our job. We need to make sure that we can help people do the thing, and businesses do the things that they need to do to grow their economies, to grow their communities, to secure their environments, their governance, their infrastructure. All of that's underpinned by the ease of transacting and doing business in a way that is transparent and secure and sustainable. So our growth strategy boils down to one simple thing, and that is making it safer and easier to do business.
Gotcha. Okay. I think another question here. What's the nature of your relationship with telcos? Are they long-term competition to your mobile value transfer vision, or are they partners?
I love this question because it's so important and it's so often misperceived. We do not originate mobile money, which means we don't have anything to flow through our pipes or populate our reports or be managed by our tools if the telcos don't have mobile money and they haven't issued, mobile money accounts to millions and millions of subscribers. What the telcos want is to increase reliance on mobile money over cash, whether that's through businesses or individuals. And we are a way to accelerate that dependency and that shift. So we are 100% strategic partners. We need them and they need us. That's not always the way that it's perceived. And I've had this conversation with various telco partners and stakeholders over and over and over again. And it's a fun conversation to have because I love to be collaborative in order to solve problems. And I love to be able to say, this is not a competitive space. This is a symbiotic relationship. We need you and we help you grow. We help make sure that more and more of your mobile money subscribers can do more things in their life and in their businesses using your product. We make the use of your product better. To go back to the pipes analogy, the more sophisticated the plumbing, the more people are going to use it.
Gotcha. Interesting. Okay, I'm going to jump back into a question that we discussed a little bit, and it is a bit of a step back into the actuality of building a company. We talked a little bit about sort of the messy middle and the idea that people really love the funding announcements and they love the exit announcements. We IPO'd and we're all rich. That's all very, very exciting. Or we just raised $5 million and we conquer the world. And not many people talk about sort of like that actual, the journey in the middle is like less exciting because it's where the real hard work gets done. So I guess my question for you is, you came in about halfway through the process, so you're joining in 2018. The team's been on the journey since 2015, 2016. What's the reality of that? Sort of what are the toughest aspects of building a fintech specifically or building a tech company in Africa? What are the places where Beyonic really had a tougher run of it? And what are the places where this was solid? This was like, we got this because we have this, from jump, basically. Yeah.
No, that's such a great question. The messy middle, it's not the sexy part. But in fairness, it's the thing that I'm most passionate about and I'm most committed to because it's that's the space where the hard work and the grind is done and where resilience is developed in the trenches. And what I mean by that is that's where you learn to come together to solve problems that you didn't think you would be able to solve And together as a small team, you live to fight another day, if you will. And that builds trust. It builds camaraderie. That's incredibly rewarding when I see my team members just moving from strength to strength and not only performing individually as professionals, but growing together as a high performance team who see the value in their ability to get things done, and that they are greater together than they are individually. I get so much joy and satisfaction out of that, because not only does that mean people are performing and solving problems well, it means that they have the energy and the passion and the commitment, and that's getting fed in a healthy and sustainable way. Our greatest resource is our people. You know, we're a fintech firm, and we don't make the product. You know, we help people use it better. So that means that our most important resource is our human capital as an organization. And if we do not sustainably manage and care for that capital, then we fall apart. We have nothing left. And in the messy middle, it's tiring and it's hard and it's complicated. And, you know, we're dealing with operational challenges, compliance challenges, cash flow can be a challenge. And it's about respecting and taking care of each other, and also solving the problems that pop up out of nowhere sometimes, and holding that balance, making sure that we are taking care of the problems we set out to solve as a business, and taking care of our people as we do it.
Yeah, fantastic. I think along the lines of the messy middle, and so still continuing this conversation about the challenges in there. For most fintech companies, I think the revenue models are pretty apparent in terms of it tends to be every time a transaction happens, we're taking a bit of it, you know, it's a toll on every single transaction that's happening. I think something that is interesting to me in considering the financials of fintech companies is how big or how small that split gets in terms of this transaction revenue. It's an interesting one thinking about, you know, combining these two entities and whatever the model is at MFS versus whatever the model is at Beyonic. So my question for you is broadly about that revenue split, how it evolves, the way you see the markets playing in terms of that. Because I do see it quite interesting where sometimes you've got acquirer, you've got processor, you've got switch, sometimes all three or four of them, and the splits can get very small. How does that affect sort of profitability for the company? How do you see that evolving across the market? Yeah.
Absolutely. It's such a great point. And as much as we wax about the beauty of mobile money for breaking down barriers, it's still one of the most expensive ways to transact for individuals. So there's a problem there that we don't have a ton of control over. We do have control over trying to innovate around practical ways to shift our profitability model and our revenue generation model so that we are not amplifying that pain for individuals and for businesses. Because what we want to do is we want to encourage transaction, we want to encourage economic activity. We don't want to discourage it by adding to what is already kind of an expensive, although very effective and safe mode of transacting. And so a lot of that, in my opinion, is, you know, transaction-based revenue, that tiny percentage, that tiny markup, whatever it might be. It's what we know, but I don't think that it is the way of the future. And I'll tell you why. It's a race to the bottom. You know, you get somebody coming into the market, they have some kind of capital or investment that allows them to subsidize their competitors, subsidize their costs so that they can outprice their competitors. And then it's just a race to the bottom. And what you end up doing is you end up creating a bunch of people, a bunch of companies who can't afford to keep their doors open and then close because they don't actually have a sustainable revenue model when it's transaction-based pricing. So what we have to be looking at and innovating around is how do we add real, genuine value to our customers so that they are, you know, looking at a more SaaS type model where you're looking at value-added services and a value proposition that is not directly linked or correlated to a transaction. There are tons of challenges around this, and no one's written a book yet. There's not a model that works. Like I referenced earlier, ad-based revenues, they don't work in Africa. So we have to find something else. And in my opinion, that's super, super exciting, because what it means is we're looking at fiscal and operational sustainability in a way that is meaningful and that is assuming the fundamental rights and dignity of the end users and the businesses that want to do commerce with them. So in my mind, that's still a challenge to be solved. There's a lot of movement and volatility and lots of people taking stabs at ways of doing that. We're one of them. But we're really committed to innovating around how we make sure that we're not shortchanging return on investment and we are paying real, genuine attention to revenue generation, because that's important. Otherwise, you know, we don't have a functional business and a lot of people lose their jobs and a bunch of businesses have to find new systems. But that also is not building our success on the back of, you know, hardworking people.
Gotcha. Okay. It's interesting. So more innovation revenue-wise coming up down the pipeline, critical. Okay.
Yeah.
Okay.
There's so much space. It just needs to be explored.
Okay. I've got a question from Kenechukwu Okoli, and he wants to know how you approach KYC issues in a complex and unstructured environment, e.g. Nigeria. I trust he's from here and not just picking on us because we're tough. But yeah, in environments where access to accurate and updated data is kind of tough to come by.
Totally.
What's your methodology for this? Yeah.
Constant ongoing challenge. The way that Beyonic has historically done it is we rely on the MNO's KYC requirements for individuals. So our system will ping, say, MTN Uganda's database, and they will check 3 data points without touching consumer data. They'll check to see that this is a legitimate, you know, MTN number, that it is active and approved by MTN according to their know your customer protocols to transact with mobile money, and that the name on that account matches the number. We won't touch any other customer data. So it's just a check. We pick the database, we get a yes, no, maybe. And maybe means it's like 80% there. And typically what we'll see with that is it's, you know, Luke Chaheri is the name on the enterprise record, and Luke John Chaheri is the name in the mobile money network's KYC database. So our system would flag that and say, we think it's like 80% of the way there, but you need to then go in and manually override and make a note. So there's an audit trail saying, yes, this is the same person. But we're able to do that without touching consumer data. And again, that's because the MNOs have done an incredible job at KYCing end consumers.
Gotcha. Okay.
And that'll keep getting better as governments invest in digitizing like ID databases and exposing those data sets to payments companies and things.
That's taking longer than it really should. And then
I know, but it's hard. In fairness, it's hard. There are a lot of reasons. That's a whole nother conversation we could have.
We could do a very long conversation on that one. Let me ask about, with cross-border transactions, a different challenge, not KYC, but currency issues.
Yeah.
How are you managing those? And especially in the last sort of few years where sort of the devaluations and the currency, where does the risk sit in those transactions? And then how are you managing them? How are you adjusting for those?
Yeah. To be honest with you, I'm in awe of our Forex team. It's growing so fast. And our treasury function within the group is, it's doubling every few months. And that's why, because it's a complicated and important challenge. There's a lot of opportunity there, and also a lot of room for, you know, pretty painful mistakes and problems to crop up. So those guys do an incredible job. It's increasingly complex.
So that's a place that has the opportunity to be both a cost. It could be a cost center. It could be a profit center.
Absolutely.
It could be the source of a lot of disaster, of real disaster, if not managed well.
Totally.
Yeah. Interesting. Okay. Question from Gideon about how you manage to keep track plethora of legislative rules impacting your business. So this, I mean, yeah.
By the skin of our teeth.
By the skin of your teeth.
Again, as we grow and as operations are wider and that complexity just is amplified, and as our various markets are increasing the sort of complexity of their own regulations around digital transactions, It's an ongoing process. We're dedicating more and more resources within the group to focusing on that. Stuff like the African trade agreement negotiations and discussions, I think they're going to have to touch on cross-border and inter-Africa transactions and commerce. But we don't know what that's going to look like yet. So really what that means is being transparent, being clear, being communicative with regulators, and being willing to have the kinds of relationships and build the kinds of relationships where we can say, like, we don't think that you know yet. This is what the market is demanding. How can we work together so that you feel comfortable and we're actually meeting the needs of the consumers?
Yeah. Okay.
Messy. It's so messy.
Very messy. Very messy. Gideon, who asked that question, has offered to help if you need any help. So Gideon,
Gideon is gonna solve compliance fragmentation across the continent, and then he's gonna get a Nobel Prize. Because seriously,
Gideon, we're waiting on you. We are waiting on you.
Please, you cannot come soon enough.
Okay. So Clinton has a question about COVID-19 and its impact on SMEs and poor communities across the continent. So his question is, how will Beyonic make a difference in a sustainable way? So you can answer that. My question is, what impact have you seen on your business because of this? So yeah.
Absolutely. So the first thing that Beyonic did on March 15th, when government started making pretty big moves to shut things down because of COVID-19, at least in this part of the world, is we waived all payments fees for organizations. Because we said, listen, the last thing that organizations need to be worried about right now is being able to afford to pay people safely. Digital and mobile money transactions are brilliant because it means you don't have to physically be in the same place in order to securely be paid. So whether that is a beneficiary payment going to a refugee or to a women's group in a rural community, or that is a payroll function going to employees who are now working from home, doesn't matter. Our job was to make sure that the last thing our customers had to worry about was being able to afford to pay their people safely and securely. So we did that for 2 months. And during that time, we saw a couple of interesting things. Organizations that were already on shaky ground, as it became clear that this wasn't a proposition of a few weeks of disruption, but it was more like a few months or maybe a year of disruption, started to decide whether or not they keep their doors open, and some of them closed. So we saw some organizations and projects just go away. The majority of people, however, adapted quickly, and what we saw was a sudden acceleration. So there was that month or that 6-week period where everybody just kind of held their breath. Like people did the bare minimum to see when will the other shoe drop? How bad will this be? Is the sky falling? And then after 6 weeks, everybody said, okay, we don't know what the new normal is going to be, but we can't just sit here. So now we're going to get up and start walking again. And what we saw is an acceleration of a trend that was already well underway. And that was just increasing digitization across all levels of organizations and operations and economies. So anything businesses could do to digitize and to improve their ability to operate remotely, whether that's people working from home or sending money digitally, either for purchases or for payments, whatever it might be. We saw a sudden acceleration of a trend that was already happening. And that actually was good for us because it meant that we were already in place and able to offer a solution to customers and people who suddenly needed that solution with greater urgency than ever before.
Gotcha. Yeah, I think that's pretty fair. It does seem like there's been a lot of that. I definitely see a lot of that in Nigeria. That sort of initial holding of breath and then the acceleration. And I think globally there's quite a bit of that as well. I have one question about, I have another question about the messy middle. It's one actually I hope Luke would jump on screen and answer for us. I see him.
Oh, is he on the call?
He is on the call. He's not responded, so I'm not going to put him on the phone. Let's see. Well, let's attempt it.
Here we go. I'll ping him.
Okay. Hi, Luke.
Hey.
Hello.
How's it going? Great to have you here. So one of the people on my team had a question about the messy middle. And I wanted you to answer it particularly because I think it's a founder question, which is, and especially because I read your piece and talked about you and your co-founder and the sort of, when it gets really tough, when the money's stretched, the payroll's uncertain, how do you keep the team together? How do you keep, employees engaged? How do you keep co-founder believing in the vision? How do you keep investors believing in the vision? What's your personal experience of that?
Gotcha. So I'm, hijacking this Carina's talk. Just been listening and it's been great, Carina.
Oh man, I invited you on.
So that's tough, right? And that's part of the things that make startups really hard is we only hear a lot of the stories about it going well, but when it's not going well, you're alone. So you've got a crowd around you when things are great, but when it's not going well, you've got a small team. And I think it's really about how you start building up that team. So you don't start being friends with your employees when things are tough because you don't want them to leave, right? You want to have this culture that you've built up where they're part of the successes, they're part of the failures, they're part of the messy middle. And also it's where you're in the same boat from the get-go, right? If you're gonna cut salaries, you've got to be the first one to take the cut. Yeah. If you say, hey, we've got to make payroll stretch out 2 months, you're the first one to take that as the founder, right? And if your investors see that, if your employees see that, that's going to build this trust that you're in it with them, right? And if there are ways to help with certain things, instead of perhaps cutting someone's salary completely, can you do things that make it cheaper for them to for rent or for something that they need money for? Can you offer, during COVID, we decided we're going to pay people twice a month instead of once a month, just because we knew folks were having issues with families and with other members of the family who were cash strapped, and so they needed money sooner. So if you're with people when the tide is high and you're with them when the tide is low, they'll be with you as well in those times. I think that's mostly what the middle is about. It's always great to have founders and co-founders who are who have the same vision, because that's when you need people the most. Yeah. And those are the people those will be the same people that you attracted at the beginning. So the kind of investors you attract, the kind of founders and co-founders you attract, the kind of employees you attract are going to be the ones who will be around then. And so that's why culture is very important. And also the same thing is true about information. Sometimes as founders, we have this question around how much information should I share with my team, right? And you don't, if you're sharing only the good news, then the problem is that when the bad news comes and it gets to a point when you cannot keep it anymore, then you have to share it, and it sounds like this is the first time folks are hearing about this, right? When you're saying we've got to cut people. But if you're saying, hey, we've got to start cutting spending because in 3 months it's going to get tough, and folks know that, then it's not a surprise to them, right? The converse is true. If you're only sharing the bad news, then there's nothing that folks are going to get bought into in terms of a vision. Like, what are they here for, right? So you want them to be part of your shared vision, and people want that. What I've found out is that a lot of times, even as an employee myself, I felt that when I felt bought into the vision, yes, money was important, but when I felt bought into the vision, I was willing to forego some of the money side of things, maybe in the short term, because I was bought into the vision. I felt I was part of something bigger.
Yeah.
Gotcha.
That reminds me of a story. I remember there was 1 month that cash was tight, and we knew we just needed to make it through like the next 5 weeks. And my choice, so I'm based in Kenya. We have teams in Tanzania, Uganda, customers in Rwanda. And my choice was we were cutting all unnecessary travel. But for me, getting my team members feeling supported and bought in was about spending face-to-face time with them. And so for about 2 months, I took a bus because it was cheaper and I could still see my people. And it's that stuff. It's sticking it out in the trenches and holding on to that shared vision, and across the board doing the things that we need to do to live that in a meaningful way. That speaks a lot to the culture and to the values of a company.
Fantastic. I think these are really good notes on which to kind of pull this conversation to a close. It's been really fantastic. Thank you so much for taking the time, Carina. Luke, thank you for jumping on. I know we just kind of sprung that on you, but it's good to have your perspective on here as well. But yes, thank you. I think it's been really interesting, really valuable. Look forward to having more conversations about exits and about sort of growth in this particular space. Look forward to hearing more about Beyonic and MFS and where you guys take it next. For the people in the audience, there is a survey. Please do click on it and fill it out so that we can make the future sessions of this better. If you're not subscribed to our newsletter, please subscribe to the TC newsletter. It's a really valuable sort of roundup of technology news across the continent. It comes out every day, Monday to Friday, 7 a.m. West African time. And our next session, our next TC Live session is September 4th, I believe, and you should come join us for more of these. But thank you, everyone, and have a wonderful day. Bye, Carina. Bye, Luke.
Thanks to me. Have a good one.
You too.